It's time now for the big picture. So let's welcome in Collin Martin, Head of Fixed Income Research and Strategy, Schwab Center for Financial Research. Okay, so as we've been saying, we're seeing things looking a little bit sort of directionless without all the data, but we do have a little bit of information coming out today. We've got some FOMC minutes. We continue to get the Fed speak coming in thick and fast, and then obviously tomorrow we'll start to get the trickling in of all this official data. What do you make of it? How are the markets likely to react?
Well, finally, we've been waiting for a while for some really, I wouldn't call it market moving data, but data that really matters for our outlook and specifically the Fed outlook. If we focus first on the Fed, we will get the minutes of the October meeting today. Now, one could argue that it's less important these days because we hear so much from Fed officials as they give interviews and do speeches across the country and across the world. So we have an idea of where they all stand. But when we look at the meeting itself, kind of a little peek behind the curtain at an FOMC meeting, most officials go in kind of with an idea of what they're going to do. And most officials around the table know kind of what everyone's going to do for the most part. And it's usually about influencing their fellow committee members for what might happen at the next meeting. So it'll be interesting to see as we go through those minutes to see, how much of a discussion there was around a potential pause last month. Now, we only got one voting member who dissented in favor of a pause, but we'll get an idea of if there were maybe more that were somewhat on the fence. Now, on the data side, tomorrow is going to be very interesting with the September jobs report. Now, granted, it's a little late at this point. We're well past September, but we'll take what we can get right now. With all eyes being on the labor market, it's going to be important to see if the recent trend continues. And by recent trend, we mean an unemployment rate still kind of below 4.5%, and non-farm payroll gains in around the 50,000 area. But to your point, Sam, a surprise either way, given that we've been in this data void, could result in some sharp swings in the Treasury market because we haven't had much to really change the narrative. And if we get this data release that suddenly suggests it's either stronger or weaker than the markets were anticipating, then you can see a move up or down in Treasury yields depending on what that outcome looks like.
So with the data tomorrow, I mean, obviously, as you say, it's a bit stale at this point, a bit backwards looking. But what we want to know is whether it confirms the trend that we've been seeing, particularly when you look at some of the more sort of private data we've been trying to pass over to get an idea of, the ADPs, the challenges of the world. Do you think it will move the needle as far as, what the market is currently pricing in as far as December? Because it doesn't seem to be really a case of just about the sort of nuanced debate that's going on the job side. More people are talking about how prices are still too high.
Yeah, I don't know if it'll be enough to move the needle, but if it were, let's say, a very, very poor, bad report, then I think it could move the needle. At the end of the day, the Fed officials, even those who are suggesting that the Fed can take a cautious approach right now and are focusing on inflation as opposed to the labor market, I feel like that outlook hinges on the labor market cooling gradually as opposed to, say, falling off a cliff. If we were to get the report tomorrow and let's say we see a large drop in payrolls and let's say we see the unemployment rate rise and by a large amount, that's not our base case, but if we saw that, I think it could give some officials pause who've been a little bit more vocal about the need to wait and see. And maybe that pushes them towards a cut in December. So I think we'll have to see how the data looks when we get it. A very, very bad report would probably result in expectations rising for a cut next month. If it just weakens gradually or, like you said, kind of stays at the trend we've been seeing, that probably won't move the needle.
Okay. What about some of the commentary we heard out of the White House yesterday with President Trump sort of hinting that he's got an idea of who he wants in the Fed Reserve come next year? I mean, how much does this matter to markets as far as the characters involved here?
I think what matters more than the specific person that President Trump is talking about is how many roles that he actually gets to fill. Because as it stands right now, really the only role that we know he can fill is Governor Stephen Myron's, who his term ends this year, and we can renew. He might look for someone to take that role permanently, because right now it's temporary. Lisa Cook, as it looks right now, is probably going to stay on. And then Fed Chair Powell, his term as chair ends next year, but not his term as a governor. And it remains to be seen if he's going to stick around or not. So there's really only maybe one to two positions that can be filled by the administration right now. So whoever he brings in, I don't think it will matter too much, because again, it's a committee. And this is a point we've been making for a while. Even if you get one view, and especially if it's Stephen Myron out, who's been super dovish, and we get another uber dove in there, that doesn't change the balance too much. We're going to be focusing on how many positions actually are available for President Trump to put in people that he thinks are more in line with the administration's thinking.
Okay, we'll be watching. Thank you so much, as always, Collin Martin, for getting us across the Treasury market today and what we're hearing out of the Fed.